There are many unpleasant effects of a recession, from concerns about job security to the sinking feeling induced by declining retirement account balances. A recession, however, is not the end of the world. Recessions are an essential and inevitable element of the economic cycle. Welcome to Good Lucks, a channel dedicated to inspiring you to expand your mindset, make general life breakthroughs, and realize your full potential to see what life has to offer. When it comes to the financial markets, history has taught us that what falls eventually rises, even though the path to recovery may be difficult. And despite what might seem contradictory, not all negative news comes from recessions. There are a few bright spots among the economic clouds that form during a recession, from the potential for greater savings account returns to the possibility of deals and inexpensive dividends in the stock market. In this video, we would like to show you how you can benefit from an upcoming recession. Let's begin. Ability to use the dollar cost average. You won't likely predict the next recession, as is the case with the majority of them. However, a stock market sell-off will probably occur far before a recession. When that occurs, keep in mind the first lesson. The stock market typically starts to bottom out far before the recession ends. Knowing this, investors can use the dollar cost averaging approach to invest to profit from a decreasing market. You already employ this strategy if you make regular monthly contributions to a qualified retirement plan. The time you start dollar cost averaging in a non-qualified investment account or increase your contributions is when the market begins to decline. By dollar cost averaging your investment, you gradually lower your overall cost basis on the share price. As a result, when the price recovers, your cost basis is frequently lower than the price. For instance, if you contribute $500 per month to a mutual fund selling 20 shares for $25, 20 shares are purchased. Your donation will purchase 25 shares if the share price falls to $20. There are currently 45 shares in your account with a $22 average cost basis. Your $500 payment will buy more shares when the share price declines, lowering your cost basis as a result. Even if your monthly contribution purchases fewer shares as the market recovers, the current share price is always greater than your cost basis. For investors who do not want to worry about the investment's performance over the long run, the dollar cost averaging strategy is the most effective. Being able to buy into dividends. The greatest equities to own during a recession are those from well-established large-cap corporations with solid balance sheets and cash flows. These businesses not only have a higher chance of surviving economic downturns than smaller ones with weak cash flows, but they are also more likely to distribute dividends. Dividends have several uses for investors. First, you may rest easy knowing that a company is financially stable and can endure most economic circumstances if it has a lengthy history of paying and rising dividends. Second, dividends act as a cushion for returns. You still earn a return on your investment even when share prices fall. These factors explain why dividend equities typically perform better during market downturns than non-dividend stocks. Investing exclusively in a dividend-paying firm through mutual funds or exchange-traded funds is the best option to buy dividend equities. High current yields and capital appreciation when the stock price rises are typical outcomes for funds that invest in firms with a long history of paying dividends and a solid track record of increasing those payouts. During market recoveries, funds that exclusively invest in dividend-paying firms may not beat the market. This is because those funds make investments in businesses that offer reliable returns over several market cycles. As a result, you can progressively allocate away from your dividend funds as the market recovers, but you should always have some as a safety measure. You can lower your average cost. Usually, the stock market experiences a dip around 6 months before a recession officially recurs. For instance, the S&P 500 was down 21% from its high in the first half of 2022, and as of August 29th, it was still down more than 15% a year so far. At times like these, it might be difficult to review your brokerage statements, but it's also a perfect chance for long-term investors to buy more shares. For instance, if you invested $5,000 in a stock that was once priced at $100 and is now only $80, another $1,000 investment will lower your average cost per share to just $90. It will also be simpler for you to break even, and instead of just breaking even, you will now make money if you return to your original purchase of $100. It helps you boost your emergency savings. It pays to put as much money as you can into your emergency savings during a recession. Not only might you require extra money for emergencies or to aid with unforeseen price increases, but you probably will gain a greater savings yield. Because the Fed raises the federal funds rate to fight inflation, recessions frequently coincide with rising interest rates. In the long run, yields usually begin to decline once more, although in the early phases of a recession, rates are frequently high and rising. During these periods, the interest that savings accounts, especially those that are online, pay to their consumers frequently experience sharp increases. For instance, the savings interest at the online bank Marcus increased from 0.5% to 1.7% between November 2020 and August 2022. This rate is expected to rise further as the Fed continues to fight inflation. It changes your mindset for the better. A recession will have some kind of effect on almost every one of us. Americans are reminded how crucial it is to live within their means during economic downturns, or at the very least, within our means. It encourages us to increase our emergency savings, plan for the next rainy day, and review our money management practices. When the economy is down, more people save. That doesn't help the economy recover, but many people could use more savings given that only 1/5 of Americans are confident that they can make it through more than 3 paychecks. The most important thing is to make sure you invest for the long term. Whether you already have money in stocks or are thinking about opening your first brokerage account, stock prices will constantly fluctuate, and the most common error is to panic and sell at lows. It's crucial to keep in mind that every storm cloud has a silver lining. When experts anticipate the next recession with zeal of a Midwestern weatherman forecasting a tornado, even downturns. A normal and inevitable phase of an economic cycle, recessions always cause suffering for those who lose their employment or enterprises. Investors may also experience difficulties during economic downturns, particularly those who are approaching retirement and cannot afford portfolio losses. Recessions do, however, contain a few benefits for individuals who are willing to take the long-term view. Although it's challenging, if not impossible, to predict when the market will bottom out, low asset values during a recession may present investors with buying opportunities. Changes in interest rates during an economic crisis can also be advantageous. Higher rates introduced to combat inflation benefit savings accounts, while lower rates implemented to promote a recovery make borrowing money more affordable. These positive aspects might help people weather the storm and set themselves up for an eventual recovery, even though they can't compensate for the economic suffering suffered during a recession. Post any more queries or remarks in the comments area. Click the like and subscribe buttons if you enjoyed the video, so that others might view it and be inspired. To ensure that you don't miss any new videos regarding personal development, enable the notification bell as well. I'll see you next time.